All right, before we get started, a couple housekeeping items for this presentation. Some of you, or maybe all of you, didn't notice, but back there, kind of like in the midfield area, Rebecca and I did a coin flip to determine who's going to go first. And she won, but she deferred to the second half. So I'm going to start. Thank goodness she did that, because she had to call an audible. I'm not prepared to present on her slides. So I'm going to kick off here. So check this out. This morning, I got up pretty early. My wife asked me, she says, "Why are you up so early?" And I said, well, we have this big CPE day presentation, and I have to try to intertwine tax and football together. She said, oh, you ought to be pretty good at that. You watch a lot of football, and your career's in tax. And I said, yeah, it's kind of like on Sunday mornings when we sit down and we put on the Red Zone channel. And what do they always say on there? You say, well, you're about to watch 7 hours of commercial-free football. But today, we have 7 hours of commercial-free CPE. That was supposed to be funny. And there's like 8 other accounting firms that are doing this too, so you could watch at home and see like, oh, we're going to go to Mike Weber. He's talking about an income tax nexus right now, and it's real interesting, and so everyone's going to dive in and watch that. She's like, you cannot be serious. I said, no, it's a joke. All right, so check this out too. We always get questions during our presentations too. You could do one of two things. You could see us in the lobby afterwards. Everyone has a red flag underneath their chair. You pull it out and throw it up and try to hit us, and we'll answer your questions. It's a tough crowd here today, really, honestly. So check this out. We're going to break our huddle and get started here. I really worked hard on this. I thought there would be a lot more laughing. Okay. All right. So what are we going to talk about here today? In this session, we're going to talk about operating out of state. We're going to talk about the different income taxes that are out there, which states actually have an income tax, which ones don't, what types of sales taxes are out there, what types of things are applicable. We have a whole series of slides on some other taxes that you might find interesting. And we took a look at some of the Pennsylvania incentive tax programs, and we're going to give you some information on that as well. Operationally as well, every state has different rules with how you register, what you need to do in terms of elections that need to be made. And Pennsylvania has its own rules, but guess what? There's 49 other states, they have their rules as well. I looked this stat up, and in the NFL, the home team has a 55% winning percentage. So look, our firm is based in Pennsylvania. A lot of our clients are based here, or even in the tri-state area, but they go into other jurisdictions. So, it's important to know what the rules are. And you think, like, when you go into these other jurisdictions, what is it that you really need to be aware of? We're here to help you navigate through that, and we're here to, reach out to other contacts that we have. But Pennsylvania has its own set of rules. Every other state has, their set of rules as well. As some of you may know, I've been teaching tax classes at a couple different, Pittsburgh area universities. And one of the things that I always start off with and asking everybody is, hey, if we put pen to paper, how many different types of taxes can we come up with, right? And those classes are primarily focused on income tax, but you can think about the laundry list of items that everybody's able to come up with. Income tax, property tax, real estate tax, Medicare tax, Social Security tax, sales tax, the other ones I have up here, employee withholding tax, franchise taxes, property taxes, local taxes. There's a whole litany of taxes that you need to be concerned about. And some of you may be familiar with this. I think this is I'm pretty sure this is the old form of the PA 100 enterprise registration. You fill this out online, right? But check out some of the other taxes that Pennsylvania has on here. Fuels, there's a fuels tax, a liquid fuels tax, small games of chance, there's different use taxes, vehicle rental taxes. This is just Pennsylvania. So you go into some of these other jurisdictions, just to say West Virginia, for example, and you pull up their equivalent PA 100 enterprise registration form. What kind of taxes are they going to have? We have some pretty cool slides and a map of the United States, and we're going to show you some unique taxes that are out there and which states actually tax. I think we have like a beer tax. Everybody likes beer, right? So we tell you where beer is taxed at. You might find that interesting. All right, with that, I'm going to throw it over to Rebekah.
All right, thank you, Mike. So to kick us off today, I wanted to start, I have my visual aid. This is my pocket-sized version of the U.S. Constitution. I'm sure you all brought yours along today also. So, you know, to start and to kick off this, this conversation about income tax, we're going to start by looking at the concept of nexus. And to go into nexus, we're going to first look at what governs and the concept of how nexus came about. So the Constitution is what gives Congress the power, the singular power to regulate and to oversee interstate commerce. So if I turn here to Article 1, Section 8, Clause 3. The Congress shall have the power to regulate commerce with foreign nations and among the several states and with the Indian tribes. So these, this very short little clause and these few words here, and among the several states, is what gives Congress this power. So, you know, a lot of times we see a lot of differences within state tax and state rules, state regulations, but in general, the U.S. government through Congress has power to regulate and to oversee this process. In case history, the U.S. Supreme Court has interpreted this particular clause, known as the Commerce Clause, to prohibit states from imposing tax rules that cause an undue burden on interstate commerce. Now, as we go through this discussion, I'm going to let you be the judge of whether or not this goal is actually reached. In my opinion, it is often quite burdensome to deal with state tax issues. But in kind of a basic goal to avoid the undue burden concept, the taxation of multi-state businesses need to meet several requirements. So there needs to be sufficient connection with a business and a certain state in order to impose a tax. So this is what is referred to as nexus. So very simply, nexus is a connection or series of connections that link two things together. Now, when we talk about it in tax, it gets very, very nuanced and sometimes onerous to determine and to apply the state tax nexus rules across 50 states and DC. So number 2, a state cannot tax more than its fair share. So this is referred to as fair apportionment, and Mike's going to talk a little bit later. We'll get into some of the details of what apportionment means by state. And then the state can't discriminate against out-of-state taxpayers and treat businesses that are domiciled within a state as better or worse than out-of-state taxpayers. Okay, so what creates nexus? Typically, there are 3 different standards by which we look at nexus considerations. There's a physical presence standard. So this is actually, in my opinion, in practice, kind of the most easy one to identify. This can be having employees. If a business has employees located in multiple states, those employees are working for that company and creating a physical presence of one company in another state. There is, of course, having physical property, so whether or not that's a brick and mortar office, if there's inventory within states, if there's other property or equipment being employed within a state, a business often has a filing requirement, and this is specific to income tax within that particular state. And then number 2, we have economic presence standard. I think this is perhaps the grayest area to apply for nexus considerations. Each state has statutes, regulations, interpretations, pronouncements that go along with all of these nexus considerations. And a lot of times we're getting pretty deep into the weeds to determine if there's an economic presence connection. So that can be very broad. It can be based on a sales factor. It can be based on a connection. So for example, if a corporate taxpayer, a C corporation, is an owner of a partnership or another type of pass-through entity, but has no activity within, for example, if a corporation in Pennsylvania has ownership of an entity that operates in 20 other states, but that C corporation does not directly operate, that corporation might be thrown into filing in 20 other states just by virtue of receiving a state K-1 from their pass-through entity. So that creates a lot of administrative burden. It can obviously create a lot of cost, for the owners of partnerships and pass-through entities. So that would be sufficient economic connection with other states. And then this third one, I think is, again, it may be a little bit easier, but can kind of throw businesses into having that connection. This is a factor-based nexus standard, and that's typically based on a particular, what we call a bright line test of sales in a state. Sometimes states impose like a $500,000 bright line test or a 25% of total receipts, that will create nexus. As well as having a specific dollar threshold for property and employees. Usually those are much lower, maybe in the $50,000 range, and each state is quite different. And also different between entities. The rules might apply differently to C corporations than to pass-through entities. So there's not really a one-size-fits-all at all for these state rules. For Pennsylvania specifically, for C corps, that factor-based standard does apply in addition to these other standards. Pennsylvania for C corps imposes a $500,000 sales threshold for out-of-state taxpayers that are operating within Pennsylvania with no other physical connection at all. All right, so I wanted to touch briefly on this Public Law 86-272. In general, it restricts, this was 1959 it was passed and used to apply quite a bit more to business operations, that it allows businesses, or did allow businesses, to have an exemption under this law for sales-only activities. So if there was a salesperson crossing state lines with displays, or going to a trade show, or soliciting orders by telephone or by mail, and that was their only connection, if sales of tangible personal property were coming into a state, but the orders were being approved by and administered outside of the state, this law specifically exempted that activity as a non-nexus creating activity. With the explosion of our modern business world of interstate commerce, online interstate commerce, this Public Law 86-272 application has gotten much more narrow, and states have found many ways around. They've found ways not to fall under, and their taxes to be outside of this scope. All right, and then finally, going back again quite a ways, in 1957, a National Conference of Commissioners on Uniform State Laws. So not authoritative, but not statutory, but authoritative. It was a group of folks that put together this Uniform Division of Income for Tax Purposes Act, UDI-TPA. This set the stage for a lot of conventions that we still use when looking at business versus non-business income and how to apply apportionment versus allocation. So once a business has come into a nexus relationship with a state, then how do we determine what type of activities get apportioned, and how does that activity get pulled into the other states? So this UDI TPA defined business income as income from normal operations, your typical operating activities, versus non-business income. And this would be extraordinary items or income from assets that are not directly employed within that business's normal operations. So for example, if a corporation owns investment property, whether or not that's stocks, if it's real estate somewhere, but it's not generating business income, then that particular income could be allocated to the state in which that property is domiciled. So it would not have to be, so if there was a gain from a sale of property, for example, that income would sit wherever that property resides. It could be the state where the business is domiciled, or it could be, another state where that asset is located. Typically, what we see and how we address apportionment is that business income is allocated, is separated among the states on 3 different factors, which Mike is going to cover.
Yeah, before we get to that, the one thing we do with every one of our clients and people that reach out to us, but more specifically our clients every year, is we send them a questionnaire asking them a variety of things so we can help them assess where they've created nexus, right, where they have a filing requirement. And you might think, okay, that's how important is that really in a lot of circumstances, but in one very recent situation, I had a client that they had created nexus in West Virginia years ago, but then really didn't have any contact with the state for a period of time. But instead of like notifying the state or doing anything, they decided to just not file any tax returns. They didn't file anything final, they just decided not to file. Well, what ended up happening is that their registration ended up getting revoked. Well, in the midst of all that, they had agreed to a contract with West Virginia University to do a job, and so the contract was agreed to. They actually started performing most of the job, all the way up to say 80 or 90%. And when it came time to get paid, the university actually looked at that and said, well, you're not actually registered to do business here. Your license has been revoked. We're not going to pay you until you go through that process to reestablish yourself. That took quite a bit of time. I think it took probably 6 to 9 months to get them back, up and running and in the good graces of West Virginia. So they were delayed in getting paid, all because really they just didn't follow the rules as they were. So I thought that was kind of interesting. So we do look at that every year, and like I said, we have a questionnaire that's designed to ask the things that are necessary so that we can help you make that assessment. Sometimes creating nexus is to your benefit, actually, and we're going to talk about that in a few slides here. All right, so again, trying to intertwine football and tax here. There are no jokes in this section, so you can relax a little bit. You don't have to laugh here, but I could recall back really when I got started in my career that this Ohio Supreme Court tax case was ongoing, and you can see here it was decided in the middle of 2015, but I can recall learning about this when I first got out of school. And essentially what had happened here in Cleveland is that they had this local, what they called a jock tax. And actually there's 8 different cities that even today still have something like this. Those are Cincinnati, Cleveland, Detroit, Columbus, Kansas City, Philadelphia, St. Louis, and believe it or not, Pittsburgh, which we're going to talk about in a second. But essentially what happened in this Ohio case is that they were trying to allocate the income that was going to be subject to the local tax in Cleveland based upon some formula that they had come up with. And of course, some of the players from opposing teams that traveled to Cleveland to play in games were challenging this calculation. Okay, so what was the calculation? Well, essentially what Cleveland, in the NFL, what they were trying to say is that, the opposing teams play one road game there, and in the course of a season, you're playing roughly 20 games. If you think about preseason, regular season, perhaps a playoff game, what have you. We know about playoff games here. I don't know if Cleveland does, but. So what they were saying is basically, look, these two players, Hillenmeyer and Saturday, I think Saturday is a little more well known, that's Jeff Saturday. He had made various Pro Bowls and actually won a Super Bowl and was the interim coach of the Colts for a little bit here a few years ago. But essentially Cleveland was saying, look, your income that's allocated to us times the tax rate should be 1/20th. And they said, no, that's really not the case, because you don't realize that we have to show up in the off season to lift weights. We practice throughout the week. We have, as per our contract, we have to go to certain marketing events. So the reality is we're actually working like 180 days in the year, and we're in Cleveland playing the game one day. So the reality is that we think the calculation ought to be 1/180th of our salary. And so that set off a firestorm, and it made its way all the way to the Ohio Supreme Court, and they actually sided with the players and said, yeah, that calculation is really not based upon the games played, it's really about the days that you're here. What was even more interesting is that Jeff Saturday, in his case during this year, he was playing for the Colts, and they had played the Browns, but he was actually injured. Not only didn't he play in the game, he didn't even travel to the game. So they were trying to actually subject him to that tax, even though he wasn't actually present in the city. I thought that one was kind of going to be a slam dunk there, which it was, and of course the other one and the methodology is there. So that actually got applied across the NBA. They have a team. There's a baseball team there. So you look at that and you say, what's the impact of changing that formula? Well, I actually went back and looked at some news articles around the time that this was going on, and the city of Cleveland thought that if all of the players that were basically overpaying this tax had applied for the refund, they would have to issue about $3 million in refunds from the city. So thought that was particularly interesting. Right now, the Pennsylvania Supreme Court is actually in the midst of hearing a very similar case, and while some practitioners don't think that this is necessarily a tax case per se, you can decide for yourself, but essentially the city of Pittsburgh has decided that if you are performing within PNC Park, Acrisure Stadium, it's tough to say that, I always want to say Heinz Field, or PPG Paints Arena, that you as the performer, right, or the athlete are subject to what they call a 3% facility fee. 3% facility fee. And so if you think about it, like I live in the suburbs, I commute into Pittsburgh, I'm not subject to the 3% earned income tax that you would have to pay, but if I live in the city of Pittsburgh, I would be paying 2% income tax and 1% to the school district for a total of 3%. So the city of Pittsburgh is saying, well, we're not treating anybody different, right? There's the residents that would pay 3%, and there are the people that come in from out of state and perform in these areas, and we're charging them 3%, so 3 equals 3. And the Supreme Court took it up on a very narrow very narrow issue to say, because there was a uniformity clause in really every state's constitution that says you have to basically treat everybody uniformly. And so the question is that uniform? Is that 3% equal to the 3% tax? Are those equivalent things or not? And we'll have to wait to see. The mayor of Pittsburgh says that we as a city collect somewhere in the neighborhood of $4 to $5 million with respect to this facility fee tax per year. And if we don't, collect that, of course we'll be, over budget, or we won't collect enough revenue, we won't be able, so we'll have to do something else. And I guess in 2022, one of the appellate courts actually put an injunction in where even from that point forward, we as a city were not able to impose that tax on anybody. So we'll have to see what happens here. The 3 people that were involved in that case were a former Penguin, who I've never heard of, the other name escapes me, and then Jeff Francoeur. I think he played for the Braves. He's the guy. He's one of the guys that's challenging this as well. So they say they've overpaid by like $25,000 apiece. Who knows? But like I said, the city of Pittsburgh thinks it's like $4 to $5 million. So, look, these things are interesting. I don't know I didn't look up any of the other cities, but in the one article I was reading that suggested that basically these other jurisdictions agree that this calculation really should be based upon the number of days that you're there and not the games, that are played. And it's an interesting issue. I'm sure, if you're a sports fan, you might think about some of this stuff. If I play for the Jaguars, right, there's no income tax in Florida, and how's that different for playing for the 49ers that has some 15% rate? And, I'm a golfer. I, follow golf, and you have some of these golfers that had lived in California and they moved to Texas and Florida and other places, so that some of their, compensation, if you will, is not going to be subject to some level of state income tax. So it's an interesting question and issue that's out there that a lot of people face. All right, relative to apportionment, though, we talked about some professional athletes here, but as Becca mentioned, the way that you apportion income is based upon a variety of factors, and talked about sales, property payroll, and how that works in Pennsylvania. And other jurisdictions are, of course, free to decide for themselves how they're gonna do that. Sometimes you have double-weighted sales, and there's maybe one-third. Every factor is created the same, and you have to work your way through that so that essentially you end up in a position where all of your income's not subject to tax in multiple jurisdictions. So you're not paying twice as much tax as you would be paying here, essentially, right? Because we're going to get a credit here for taxes paid somewhere else as well. So, these things are out there to kind of help you navigate through this. I've actually dealt with this issue quite a bit over the course of my career, where we've had, and a couple of you in the audience here have actually helped through this issue where essentially you're filing a Pennsylvania return, but you really ought to have been filing Pennsylvania plus some other places. And what ends up happening is that your Pennsylvania apportionment goes from like 100% down to like 2%, right? And your tax goes way down. And then the question becomes, okay, well, like, where's the other 98% of the income taxed? Well, it's only taxed in the jurisdictions where you have nexus. So, like, if we only have nexus in Virginia also, and that apportionment's 2%, where's the other 96? Well, the reality is it gets taxed nowhere. And the reason for that is because you can see up here, I'm accustomed to always pointing behind me, but there's no slide deck up there this year, so I'll have to point over there. You can see Pennsylvania doesn't have a throwback or throwout rule. Essentially what that means is that if we have sales that are occurring in my example, say Iowa, right, and they're taxed nowhere, you don't have to bring them back into Pennsylvania to put it into that factor and subject that income to tax. So not every state follows that rule, but we do. All right, sales tax obviously has been a hot item. You'd basically have to be living under a rock at this point to not know what this Wayfair case is, but essentially, well, prior to the Wayfair case in 92, the Supreme Court took up a case where they basically defined, or they came up with that physical presence standard. A state can't compel you to do something unless you have a physical presence in that state. And South Dakota came up with their own rule and said, essentially, hey, look, if you've got, whatever, I think in that case it was like $200,000 of activity, it's as if you have a physical presence. We get this question a lot from clients, do I have an obligation to do something? Is something taxable? What's the rate? Is there an exemption? For those of you that have worked with me, and we've talked about those types of things really at length since this Wayfair case came to be in 2018. It's really a tricky area and something you really need to pay attention to. And I always tell my clients, you really have to understand the biggest thing for me is in the neighborhood of sales tax is that it's not your money, right? So all you're doing is acting as an agent for the state. So you collect it and then you pass it on. But if you end up in hot water, what you have to end up doing is taking that money out of your pocket and forking it over to the state. So, follow the rules. You don't want to be in that spot. It's someone else's money that you should be transferring over to the states.
Okay, so on the previous slide, there were 2 points about tax rates and tax base. I'm going to focus on just a little bit of a discussion about tax rates among different states, but I also want to note here that the tax base, when we're talking about sales tax, is probably just as important as the different rates among all the different states. The tax base, which is the states have different rules on which types of services and transactions and property the sales tax applies to. Very, very wide range of rules depending on which state we're talking about. So that's one component of application of sales tax rules is, if there is a piece of property that I am selling in Virginia and it's taxable for sales tax in Virginia, is that same type of property taxable in Pennsylvania or services, for example? So that's what we mean by tax base. So that is quite disparate in among the states. The other point here is the sales tax rates. So in a broad, generally speaking, we have 45 states plus DC that impose sales tax in some fashion, including, that in that 45 states plus DC does not include the jurisdictions. So 38 states also impose or allow the jurisdictions, localities within the state to impose their own sales tax. Obviously, we see that in Pennsylvania. We've got Allegheny County, an additional 1% in addition to the 6% state sales tax, so 7% here in Allegheny County. The states that do not impose the sales tax: Alaska, Delaware, Montana, New Hampshire, Oregon, although Alaska does have a very small average sales tax rate just because they permit localities to charge sales tax. So when we're talking about all these different factors combined, it's very substantial, very significant when businesses are looking to operate in which corridor, in which state. Like Mike said, maybe you want to create nexus for income tax purposes in certain states so that you can apportion or allocate income out of the state in which you're domiciled. Sales tax is no different. There could be corridors. I think there is a section up in New England. There's a major highway. Businesses sometimes make a decision to operate on one side of that highway or another, just depending on which states in that corridor charge sales tax or don't charge sales tax on whatever they're selling. So there can be significant business decisions that are based on some of these tax factors. The highest rate that we find is about 9.6%. Combined sales tax rate in the country. The lowest, that 1.8%, is Alaska because they permit localities to impose sales tax, but a lower rate is somewhere in the 4 to 5. An average, we have about 6% is average across the nation. So Pennsylvania is kind of right in the middle. And then I thought this was kind of an incredible number. This is based on 2022 figures. $445 billion of state tax revenue is sales tax related, which is just, in my mind, a massive amount. But, and I think that represents about 30-some% of the tax revenue that states collect. So I wanted to give a few nuggets on Pennsylvania's sales tax base. So the sales tax in Pennsylvania was first imposed in 1954, and the goal at that point, in theory, is that sales tax is applicable to things that are not considered necessities. So you can decide here if once I'm going through these, if these taxable versus non-taxable things are necessities versus luxuries. So when I was looking at this, I thought it was interesting. Leather clothing in Pennsylvania is not taxable, but any item made of fur is taxable. Toothbrush, toothpaste, and dental floss. Those are not taxable. I think we all agree those are necessities, but items such as mouthwash, shampoo, and antiperspirant are taxable. Candy and gum, I think we can thank our friends at the Hershey Company for their good efforts here. Candy and gum are not taxable. However, there's certain levels of sugar content that is permissible, that if a product does not contain more than 25% fruit juice, so they have a high sugar content or not as natural as fruit, so soft drinks and fruit drinks can be considered non-taxable. So high sugar content there, but candy and gum not taxable. Bottled water is taxable. Bottled water is not taxable. Vitamins are not taxable. Vitamin water is taxable. And then finally, if you grab a bag of chips or a package of cookies on your way home from local Sheetz, those are not taxed at Sheetz at a convenience store. If you buy those same chips and cookies at Subway, right across the parking lot, those are taxable. They're considered restaurant sales. Okay, so this graphic just kind of pulls together, it's I think a nice visual of what I mentioned. I thought it was interesting, so this is showing an average sales tax across the states. Those lightly shaded states, of course, are the ones that do not impose sales tax, but I thought it was interesting that the higher tax states are not concentrated really in a specific geographic location. It's pretty broad, and the states that impose the highest tax, Louisiana, Tennessee, and Arkansas, their rates are about 9.5%. The lowest tax states, Wyoming and Hawaii, those are closer to 4%. And again, this is just rate-based. This does not mean that a state is has a low sales tax application in their base. This is just strictly rates by themselves. All right, so here I just want to mention about with employee withholding tax. So not necessarily a tax imposed, of course, on the business activities themselves, but really can be a factor in what generates nexus. As we already talked about, having employees within a state can throw a business operations into an income tax situation within that state. And that has wide application now in our arena of remote employees and remote work. It used to be that there was not much definition from a state statutory perspective in how to, if there was employees working in another state remotely for a Pennsylvania-based company, how does that impact that state? And a lot of times now that means that a Pennsylvania-based company will have a tax filing requirement and obligation, in Colorado for hiring a remote employee in Colorado. Some states have a lot of definition on this, and some states it's still a grayer area, but we get into the weeds and get into a lot of research on this topic specifically to try to determine what obligations our clients have when they hire employees remotely. And then I note here reciprocal agreements. This is just, I think most of us are aware that we have friendly relationships with our neighboring states, so that if we have employees who live and work in border states, it takes some of the burden off of employee withholding specifically. And then franchise taxes are essentially taxes levied for the privilege of doing business within a state or a jurisdiction. These can be quite substantial. We have a client, Mike and I have a joint client who has a business domiciled in Oklahoma. The maximum amount of franchise tax that any business can pay in Oklahoma is $20,000 annually, and so this client meets that $20,000 threshold. It's quite onerous that they are paying for the privilege of doing business to the tune of $20,000 a year in Oklahoma. California, we find that California doesn't want to leave anybody out and imposes $800 of a minimum filing fee annually on most businesses that operate in California. And then, one thing that makes this challenging specifically franchise tax, is that the landscape changes very frequently. Tennessee, for example, had some legislation at the beginning of the year which actually was favorable to a lot of taxpayers, or to some taxpayers. They changed their base for the imposition of their franchise tax and created some refund opportunity for some of our clients. And then I don't know if some of you'll remember, Pennsylvania used to impose the capital stock tax. That was done with, I think at the end of 2015, so for tax years post 2015, we didn't have to worry about that anymore, but businesses that were LLCs, pass-through entities, were required to file the corporate tax report, not for income tax, but for this capital stock tax. So, that keeps us on our toes, really, this ever-changing landscape of taxes, and specifically franchise taxes. And then the last point that I wanted to mention is that local taxes within localities, some states have mercantile taxes or business privilege taxes, again, kind of a tax for the privilege of doing business within that certain jurisdiction. I know McCandless for Ross Township, we have some clients in Ross Township. I'm sure a lot of the other many of the other jurisdictions in Pennsylvania impose a certain percentage on various types of business industries that operate. It's usually based on a gross receipts measure. And then Mike, you had a very relevant real-time experience with this.
Actually a couple of days ago, we had a client reach out to us that got, I don't know, it was like 10, 15 of these notices in the mail saying that Greensburg was wondering why they hadn't filed this tax return, and North Hills and Reading, PA. It was all over the place, and so they were really wondering what it is they were supposed to do. And the tricky thing for them is how are you supposed to, in their case, it's kind of a unique business, but how are they supposed to allocate the revenue across all those jurisdictions? So they, for them it was a question of what's the right thing to do and what practically can we do. But that really just came up just a couple days ago.
Skip back to property tax.
Yeah, back to the sales tax thing. I always find this interesting. Everybody travels for vacation and such. You go to different places, and I had just recently traveled somewhere, and they had a 4.7% tax that I was paying even when I went out to breakfast, and they charged me that on my coffee in another jurisdiction. And I can remember we always vacation to Myrtle Beach every year, so we go down to South Carolina, and it's usually right at the end of the summertime, but right before school starts. It's kind of the cheapest way to go if you want to go in the summertime. And during that last week, they have a sort of back to school holiday on their school supplies and clothing and such, right? So for that week, you don't have to pay sales tax on those items. So then I start going with my wife and daughter, so then they see that, and all of a sudden I get banged with all these different school supplies and clothing items, and they say, well, we're saving all this sales tax. So I got smart and I looked that up, and we go a different week, and I just saved the full value instead. So these things are out there. They incentivize you to buy this stuff, right? I think I've exhausted all my jokes at this point. I'm reaching deep now. Okay, there are a lot of different types of taxes, obviously, that we deal with. One of the things, we don't have a lot of exposure in this area, but personal property taxes, we know Florida has this, West Virginia also has this tax, and we actually have a graphic up here that shows you which states tax, the movable property and such. And this also becomes a question of, how are you in the right jurisdiction, not within a particular state, but within that state, right? Where is the property at? Do you have multiple locations, and which county may be subjecting you to that tax? So that's another thing that we deal with from time to time. All right, this might be everybody's favorite slide here. Beer tax. Okay, we pulled this down. Where was this from? The Tax Foundation? Mm-hmm. Someone's got all these charts out there, and I'm always interested in not just kind of looking at something and saying, okay, well, yeah, it's kind of interesting that, say, Kentucky has this particular, tax, and Tennessee has this tax, but the other places have lower tax. Like, why is this? Why are these two states, red? The only thing I could come up with is, like, that's where I think whiskey is produced, so maybe is this some type of protectionism against that industry, and that's why, beer is more heavily taxed there than other places. I don't know, food for thought there. Gas taxes. Hey, have you ever driven down the East Coast and you're in West Virginia, North Carolina, South Carolina, you wonder, what? Hey, it's the same gas station like across the street, but it's $2.98 here and $3.28 over here. What's the story? Well, every state has different gas taxes. You can see up here, who's got the high taxes, who's got the low taxes. So Pennsylvania is kind of trending towards that higher zone. And, so if you live kind of on that border, which one of us on this stage lives kind of close to the PA-Ohio border and the other one doesn't, so some of us drive.
I save 40 cents a gallon sometimes by going to Ohio. I live very close to the Ohio border, so we always fill up in Ohio.
It's interesting, the things that are out there. So why do you retire to Florida? I think it's the nice weather. No, they don't have an inheritance tax. That is probably a reason why people do that, for sure, but check out this. I actually thought in my mind, I thought more states would have an inheritance tax, but after looking at this, this was a little shocking to me. Look, there's only a few that have this, right? Of course, we're one of them. I think probably most of us in this room are familiar with how that works, but look at all the states out there that don't have anything to say with respect to estate or inheritance taxes.
Okay, so now that we've determined that everything has been successful and that there is no undue burden placed on interstate commerce, I just want to mention here the importance, of course, of record keeping in trying to pull together all of the application of these taxes on businesses. Of course, we are big proponents of record keeping. It really helps facilitate the job that we do, but it also can make the business administrator's life much easier if records are in good order. It can help if there's ever an audit of a certain taxing jurisdiction. It can, of course, help with various opportunities that we come across. Mike, do you want to mention briefly, or you want me to mention what your opportunity was? And if you didn't have good records, you wouldn't have been able to assist in that situation.
We had sales tax. It wasn't an audit; it was actually a refund situation. And fortunately, the client really did a fantastic job in maintaining the records that were necessary to prove that they were entitled to this refund. And really, that was the only sticking point between us and Pennsylvania, was whether we could prove to them. Right, there was no debate about what the law was. It was really a substantiation. Could we prove to them that we were entitled to the amount that we were requesting? And we could, in fact, do that. And we're still waiting on that money, but we were able to get that back.
All right, I'm going to briefly mention some of these tax incentives. So looking now at our home state, why would businesses, other than a strict other non-tax related considerations, why would some businesses choose or be incentivized to operate here, and what does Pennsylvania offer? We assist clients, of course, with R&D credit. I know there have been many sessions in the past talking about R&D credit on a federal level, but Pennsylvania also offers R&D credits to businesses engaging in qualified activities, so that can be an incentive. One interesting difference between the Pennsylvania and the federal R&D credit is that Pennsylvania allocates a specific dollar amount of the budget annually to the R&D credit, and so there's one big pot that taxpayers are trying to get a piece of. So all these applications are submitted for R&D credit in December. And then Pennsylvania goes through and determines which ones are qualified, and then allocates a portion of their budget and of that amount to taxpayers. So if I had a taxpayer a few years ago apply for a certain level of R&D credit, it was in the $7,000 range. They ended up with a little less than $2,000, just because there was not enough to go around for all the applications that were received. Many of us are familiar with the EITC, Educational Improvement Tax Credit. Taxpayers can make a contribution commitment to certain specific organizations, charitable organizations, educational organizations, and receive 75 or 90%, depending on a 1 or 2 year commitment to that contribution, and receive a credit against taxes. It can be applied to corporate net income tax, can be applied to individual tax. And then there are quite a number here. If you're looking for additional edification later on, you can go through and find some of these, which are additional incentives for certain economic and geographic areas. And then MyPath, I think most of us in the room are familiar. I think it's actually a very good resource. It came out, I want to say 2, maybe 3 years ago. It went live for the majority of taxpayers, so it's for business and individuals. We use it quite heavily to assist our clients with determining what's on account. It seems like the Stone Age just a few years ago, where we had to call Pennsylvania and go through many layers of automated recordings to find out what was on account for our individual and business taxpayers for estimated payments. That's now very streamlined through this MyPath. Many things that we can assist taxpayers with through MyPath.
Yeah, the last thing in our slide deck here is just this annual report. We talked about this last year. Pennsylvania has that. Now we're coming up in 25. You have to provide them various levels of information. Time doesn't allow us to go through everything, but be alive for that, because there are penalties and situations where your registration can be revoked. So look, there's a break after this, I believe, and we're standing between you and that. So thank you for your time, and come see us afterwards for any questions.